The current situation of capital outflow is very serious. It is widely reported online that funds from celebrities, entrepreneurs, and even corrupt officials are flowing out. How much exactly? Although not necessarily exact, one number that's been mentioned is 15 trillion US dollars. This figure is astonishing and indicates a severe situation of capital outflow. Moreover, if you look at Shanghai, where there used to be 200,000 foreign investors, now only 60,000 remain. That's a 70% decrease. Why is that? Because currently, China's investment environment is not favorable. People simply can't make money here. Therefore, there is a significant trend of transferring funds outwards, resulting in capital outflow from China. Chairman of Hill House Capital, Zhang Lei, and Sequoia Capital China's founding partner, Neil Shen, have both migrated to Singapore. The migration of Chinese businessmen to Singapore has been a known fact. But when Neil Shen and Zhang Lei joined this group of migrants, it shocked many people. Zhang Lei is known as the Chinese Warren Buffett, and Hill House Capital is known as the largest investment institution in China and even Asia. Hill House Capital has invested in well-known companies such as JD.com, ByteDance, Meituan, Didi, Ant Group, and the automobile manufacturer NIO. They have managed funds of up to 73 billion US dollars. It is not an exaggeration to say that almost half of China's businesses are shadowed by Hill House Capital. Zhang Lei is also a supporter of the real economy. For example, he invested heavily, committed 50 billion yuan, equivalent to around 7 billion US dollars, to acquire Bell International. He also invested 20 billion yuan in the home appliance company Gree Electric. Recently, there have been continuous reports of top Chinese figures migrating to Singapore. The list includes Chinese businesswoman Lucy Peng, who is a co-founder of Alibaba, founder of Haili Dao Restaurant Group, Zhang Yong and his wife, as well as Alibaba co-founder Jack Ma's wife, Zhang Ying, who bought 3 commercial properties in Singapore.
In China, the political and economic environment is worsening. Chinese authorities are cracking down hard on domestic tech giants. They're also calling for common prosperity. This has deeply worried Chinese business people about the safety of their wealth. In recent years, a large number of wealthy Chinese have migrated to other countries and have hurried to transfer their assets overseas. The increasing control exerted by Chinese authorities over Hong Kong has made it lose its status as the preferred destination for wealthy individuals. Singapore, on the other hand, has become the preferred choice for these people due to 2 primary advantages. These advantages are language and taxation. Most people in Singapore are fluent in Mandarin, which not only provides linguistic convenience for wealthy Chinese, but also enhances Singapore's appeal. Furthermore, Singapore does not have property tax, which saves them a considerable amount of money, making it a significant advantage in attracting funds. Recently, media covered the news that Neil Shen, the founder of Sequoia Capital China, obtained permanent residency in Singapore. Sequoia Capital China is a prominent technology investor and private equity institution in China. According to sources, Shen obtained his immigration status before the pandemic outbreak. At the age of 56, Neil Shen is a billionaire renowned for his early and precise investments in companies such as Alibaba, TikTok's parent company ByteDance, and the online fast fashion brand Shein. Neil Shen has also been a major investor in hundreds of digital technology companies, including mobile company Sina Corporation, 360 Security Technology, shopping platforms JD.com, Meituan, Pinduoduo, and news platform Toutiao. This range covers almost all important investments in the fields of artificial intelligence, big data, blockchain, and the Internet of Things. According to Financial Times, a source close to Neil Shen stated that his decision was made for personal reasons, making it easier for others to follow suit. Although the move was made public only recently, it has become widely known in the Chinese business community that Shen obtained permanent residency in Singapore before the pandemic. In 2023, Sequoia Capital China was renamed Hongshan and expanded its operations to Singapore. It separated from the American Sequoia Capital in June 2023 and opened an office in the Singapore Financial Center. In a statement, Hongshan said that the decision to open an office in Singapore was made for business reasons and was not related to any personal matters of its executives. Hongshan had previously stated that the establishment of the Singapore office was to comply with local legal requirements. Since then, Hongshan has begun to globalize, seeking business opportunities and investments worldwide, thus benefiting the Chinese companies it invests in. Three informed sources revealed that since the COVID-19 outbreak, Hongshan has encouraged Chinese companies it invests in to establish entities in Singapore for international market entry. In the past 2 to 3 years, many companies supported by Hongshan have moved their offices to Singapore. These include Chinese artificial intelligence startups Moonshot AI and Hi Robotics, as well as TikTok's parent company ByteDance and the fast fashion group Shein. Recently, the United States Congress named and criticized Hongshan, Moonshot AI, and ByteDance in a report that reviewed U.S. capital investments in Chinese technology companies. The investigation found that these companies aided and supported the Chinese authorities' military actions and repression of ethnic minorities in Xinjiang. Apart from Hongshan's founder, recent wealthy Chinese who migrated to Singapore include the co-founders of Boyu Capital, Shan Tong, and Louis Chung. Boyu Capital is a private equity firm established by former Chinese President Jiang Zemin's grandson, Alvin Jiang. Boyu Capital opened an office in Singapore in 2019. The founder of Dianping lifestyle information and trading platform, Zhang Tao, moved to Singapore, as well as the internet company Sea Limited and online shopping platform Shopee's founder, Forrest Li. Hill House Capital Group's founder, Zhang Lei, the wife of Alibaba's co-founder Jack Ma, Zhang Ying, the founder of Haidilao Restaurant Group, Zhang Yong and his wife, and Mindray Medical Equipment Manufacturers co-CEO, Li Shiting, all moved to Singapore. In the past decade, China has ranked first in the net outflow of millionaires. Australia, the United States, the United Kingdom, Canada, and Singapore are the top destinations. Wealthy Chinese have sparked a buying frenzy overseas with a large amount of capital moving abroad. According to UK investment migration consultancy Henley & Partners, in 2022, more than 10,800 millionaires chose to leave China. On average, each millionaire took about $6.6 million with them. In other words, in 2022, wealthy Chinese took away $71.2 billion in wealth from China. In 2023, it is estimated that the number of millionaires immigrating from China reached 13,500, which is an increase of 25% from 2022. It is expected that by 2025, the number of wealthy immigrants will exceed 700,000. The top preferred destination for wealthy immigrants is Australia, followed by the United Arab Emirates and then Singapore. This means that in 2022 and 2023, wealthy Chinese immigrants have taken about $160 billion in wealth out of China to other countries. Global wealth intelligence firm New World Health's head of research, Andrew Amoyles, explained in a report that China's overall wealth growth has been slowing in recent years, meaning recent capital outflows may be more disruptive than ever. With uncertainty in the Chinese economy after the pandemic, an increasing number of Chinese individuals are transferring their assets overseas. They aim to diversify their investments or make preparations for potential future emigration. Chinese funds are flowing into overseas investment funds at an exceptionally rapid pace, reaching the limit for overseas investments set by Beijing authorities. According to Reuters, data from the Asset Management Association of China shows that sales of qualified domestic institutional investor funds, QDII, in January increased by 50% year-on-year, reaching a historic high. The QDII program is an important channel for overseas investment, allowing Chinese citizens to purchase foreign securities under Beijing's strict capital controls. In contrast, sales of domestic stock mutual funds in China fell by 35%. QDII fund assets under management increased by 19% year-on-year. Recent tracking of the Nikkei 225 and Nasdaq-listed exchange-traded funds, ETFs, has revealed premium risks, with buyers bidding significantly higher than the value of the underlying assets to secure shares. Reuters reported that this surge in overseas investment not only reflects Chinese investors' lack of confidence in the domestic economy, but also highlights the pressure faced by China's capital account and currency, as well as the challenges faced in rebuilding domestic investors' confidence in the domestic market. Currently, the Chinese stock market is approaching its lowest point in 5 years, while the yield on China's 30-year treasury bonds have fallen to historic lows. Shanghai-based FR Harvest Asset Management helps clients invest through QDII. Founding partner of the company, Le Rong, said they feel a pressing need from the wealthy clients to diversify asset allocation. After 20 years of high growth and high returns, the Chinese economy faces a slowdown in the foreseeable future. The QDII program is subject to quotas or limits on overseas investment set by China's State Administration of Foreign Exchange. According to official data, no new quotas have been granted since July last year. The current cumulative approved quota is at $165.5 billion US. China AMC has set a daily subscription limit of 2,000 yuan, equivalent to $277 US, for investors in its Huaxia Global Technology Pioneer Hybrid Securities Investment Fund, which lists U.S. tech giants as one of its largest holdings. Manulife Fund Management has set a daily maximum purchase limit of 300 yuan for its India Opportunity Stock Investment Fund. According to two informed sources, another QDII product sold in China is investing in a BlackRock UK hedge fund. The funding this year has increased by 5 times, raising nearly $12 million US compared to $2.1 million US raised in 2023. One of the sources said local investors' demand for QDII funds has gone insane this year. China Resources Trust, which jointly launched the product with BlackRock, said the product paused new subscriptions in March. A BlackRock spokesperson did not respond to requests for comment. Standard Chartered recently blocked new investments in QDII products by its Chinese clients for commercial reasons. Portfolio manager of China AMC's QDII fund, Zhang Peng, expects this trend to continue. This is with the current demand driven by the gap of almost 190 basis points between U.S. and Chinese 10-year government bond yields. In addition to overseas investments, Bloomberg reported earlier that many wealthy Chinese individuals do not choose formal channels when transferring assets, but instead rely on underground banks. Chai-Shin Kun, a financial commentator based in the United States, told Voice of America that in China, underground banks appear in various forms to meet the needs of different clients. Some appear under the guise of large trading companies. They might conduct trades overseas to receive US dollars and then receive Chinese yuan domestically, profiting from the price difference. Many accumulate numerous IDs or borrow IDs from relatives or acquaintances. Nowadays, the operations have become more fragmented. Previously, a single transaction could involve millions or tens of millions of Chinese yuan, but now each transaction is divided into smaller amounts, possibly just hundreds or thousands of Chinese yuan. Another method involves receiving Chinese yuan domestically under the guise of foreign funds, allowing you to select suitable investment projects, and then they pay you in foreign currency overseas. According to Bloomberg, the UK Secret Intelligence Service mentioned that many underground banks in China frequently collaborate with criminal groups to raise cash through activities such as drug trafficking and cigarette smuggling. The scale of operations of underground banks in China remains unconfirmed to outsiders. Chinese state media previously reported a major case of an underground bank that was exposed in Gansu province. It involved a staggering 75.6 billion yuan, equivalent to $10.5 billion US, and over 8,000 accounts across more than 20 provinces in China. China implements strict foreign exchange controls with stringent limits on annual foreign exchange remittances per person. Restrictions also apply on carrying Chinese yuan or foreign currency cash when exiting the country. Individuals can only transfer their entire assets overseas in a single transaction when emigrating. Cai-Shin Kun mentioned that the inability of wealthy individuals to transfer large amounts of cash overseas through legal channels is a factor driving the flourishing of underground channels. Each Chinese citizen is limited to an annual foreign exchange quota of 50,000 US dollars. Also, detailed information must be provided regarding the source and purpose of the funds transferred overseas, and it needs to be reported to the State Administration of Foreign Exchange for review. Currently, there is virtually no way for large sums of funds to be transferred out of the country. China's underground banking network spans globally, with some claiming that wherever there are large numbers of overseas Chinese, there are institutions operating. The UK Secret Intelligence Service indicates that these underground banks typically pre-position significant funds, enabling recipients to swiftly convert Chinese yuan into local currency. Many wealthy Chinese individuals are keen on overseas real estate and financial investments, but Chai Shen-kun stated that with the Chinese authorities tightening regulations, many investors must rely on underground banks to mobilize funds. Chai Shen-kun mentioned, as an example, a hotel may be valued at $1 billion US, but when signing the contract, it's signed at $2 billion. The extra $1 billion is then passed through several hands, and ultimately, the enterprise will transfer the money to the other party. Many enterprises are willing to do this. They will help you launder $1 billion and can even charge a commission. Later, they'll charge you another $10 or $20 million. But since the Chinese government discovered these issues, even state-owned enterprises now require strict approval for overseas investments. Currently, when buying a house overseas, whether it's worth tens of millions or even hundreds of millions of dollars, it's all money laundered through underground banks. Economists from the French investment bank Natixis mentioned that many Chinese tourists take advantage of trips abroad to transfer cash. Based on travel data, it is estimated that $150 billion US flowed out of China in 2023. Some financial advisors noted a surge in demand from Chinese clients to transfer assets overseas. This is related to the uncertainties in geopolitical tensions and the common prosperity policy that is perceived as a threat by the wealthy and even members of the middle class. According to CNBC, another method used by wealthy Chinese individuals to transfer assets is by establishing family offices. Many opt to establish these in Singapore. According to the database company Amicus, as of August 2023, wealthy individuals who have established family offices in Singapore come from more than 60 regions worldwide. Among them, the number of wealthy Chinese is the highest, with nearly 700 people, accounting for 34%. Most of these individuals come from Hong Kong, followed by economically developed regions such as Shanghai, Guangdong, Beijing, and Zhejiang. In February this year, Jack Zhou, the research and strategy director of Yunfeng Financial Insurance Company under Jack Ma and David Yu, hosted a multifamily office opening ceremony in Singapore. He disclosed to Chinese media that the initial capital for the family office is approximately $100 million US. According to the Global Wealth Report 2023, there were over 32,900 individuals in China with assets exceeding $100 million US in 2023. This is second only to the United States. However, the trend of capital outflows will lead to the disappearance of millions of dollars in wealth from China, further intensifying the situation of economic slowdown in China.